Hello everyone, I'm Jared Hall. It's Monday, April 7th, 2025. Welcome to the week ahead. All of the major market indices declined in a fashion we have not seen since the COVID-19 pandemic in the spring of 2020. The S&P 500 index declined 9.1% alone last week, putting the index down over 17% year to date. As of mid-afternoon this Monday. Mid-morning this Monday, declines in the S&P put the index in a bear market, being down over 20% from recent all-time highs. The tech-heavy NASDAQ index looks worse, declining over 22% from highs, while even the blue-chip-weighted Dow Jones was off almost 16% this year. Remember, only bad things happen fast. This is true with most areas in life, but especially in the public marketplace. Markets have always gone down much quicker than they've risen, as behavioral analysis shows that humans react illogically to fear, causing these sharp reactions. Several times over the previous episodes, we've talked about support levels for the S&P 500. Support levels are technical areas of price action where the buying and selling equilibrium should attempt to normalize. The lesson here is that these support levels do not always hold. Once they are broken, older levels of support are tested and new levels are formed. It is ever evolving. Lastly, and we will cover this later in a graphic, but the panic selling has always historically cost investors money over the long term. So how far is the market corrected? Well, if you look back to almost the beginning of 2024, this chart shows that the major indices are all negative on a rolling 12-month basis. Checking out the sector performance for last week, none of them were able to weather the storm of fear that gripped the markets. Looking in depth at the support areas we mentioned a second ago, the S&P 500 index quickly gapped through 5,500 level and tested prior levels not seen since May and August of 2024. New key ranges to watch for stability in the buy-sell dynamic should be between 5,225 and 5,000 even on the S&P 500. One thing we'd mention quickly now that we've broken key areas of support is that these areas can often turn into resistance levels on the way up as the market eventually turns around. The last thing we wanted to cover before we talk about the economic and political events that might impact this coming week's markets are some graphics geared for investors who feel some panic right now. Check out this graphic that shows the distribution of the best performing days of the S&P 500. The 25 of the 50 best days in terms of performance in the S&P 500 from the years 1992 through 2021 occurred during a bear market. An additional 13 or 14 occurred during the first 2 months of a new bull market. So what does this mean? It means that being invested right now has historically been more important than being invested at the height of a bull market when things feel good or your confidence is high. The next graphic tells a similar story in a different way. It shows the hypothetical growth of a $100,000 investment starting in January of 2000 all the way through 2024. The various graph lines show the opportunity cost of missing the best 10, 20, 30, 40, and 50 days in the stock market. Notice that if you missed the best 50 days over the last 24 years, you actually had negative portfolio returns. So please, if you hear one thing today, hear that you should not panic sell in this environment. Portfolios are meant to be rebalanced methodically and consistently, not when you're at the pinnacle of your fear. Looking ahead to this week, the market will primarily be keying in on tariff developments or changes with the bulk of the reciprocal tariffs set to begin on April 9th. Q1 earnings season will also start this week, and we will end the week with a look at the Consumer Price Index. This data will not showcase any impacts of tariffs yet, as that will be months delayed. Economists are looking for the core CPI number to come down from 3.14% to 3% for the month of March. That's all for this week. Thanks for watching. Be sure to follow along with us for more content like this.